In recent months, there are more and more interest in the Japanese market. And the Japanese stock index, the Nikkei 225, actually appreciated around 30% alone this year, making it one of the best performing markets so far. Yet the Japanese stock market has been rather muted over the past 30 years. In fact, since the peak of its market back in the 1990s, Nikkei 225 index has only appreciated 0.6% a year over the past 32 years. And many investors have written off Japan after their asset bubble bursting back in the 1990s. However, as uncertainty is rising now in the world, Japan seems to be on a steady course of growth. So is the sun finally going to rise again in the land of the rising sun? And how can you gain exposure to this interesting market using the exchange traded fund method? Let's explore that today. So the story of the Japanese market, we really have to start after World War II. During that time, Japan was in disarray. The country just lost the war, two of its cities were completely destroyed by the first atomic bombs. Japan military was disbanded and the country was officially under occupation by the US. However, it is also a country determined to rebuild. At the same time, US was also eager to develop Japan to prevent the further spread of communism in the region. Communism at that time has already spread to Korea and China, and the US really needed Japan to stay an important ally in the Pacific. So all this led to massive investment into the Japanese economy. Over the next few decades, Japan started out as just a low-cost manufacturer, but as its manufacturing quality improved, many of the industry in Japan become serious competitor to the US. And this is particularly prevalent in the automotive and electronic sectors. The competitiveness of Japan boosted investment interest in the market as well. So from the 1970s, Japan experienced one of the greatest boom they have ever experienced. By 1980s, Japan became the second largest economy in the world. And that brought it into attention of its big brother, the US. And due to the huge imbalance in trade surplus between the US and Japan, the US government started imposing more and more tariff on Japanese export to the US. This trade war really affected very key sectors like textile, iron and steel, home appliances, automotive, and even the tech sector. And the involvement of the US government in Japanese economy and politics increased over time, forcing the Japanese government to open up more sectors to the US to export their products into Japan as well. It also reached a point where the US government forces Japan to share some of its semiconductors technology with US counterparts. However, at the same time, the market in Japan was getting overheated with widespread speculation in its property and stock market. The market finally popped in the 1990s across all major asset classes. Its property prices continued dropping, and many of its financial institutions failed or needed to be bailed out by the government. This period is commonly referred to as the lost decade in Japan. And investors lost interest in Japan. And some of the more common excuses for avoiding Japan might be saying that they have an aging population, or the business practices in Japan, with many cross-holding in the stock market, make it hard to realize the full value of the companies. But slowly, there are signs of a recovery in the Japanese economy. Just when Japan was starting to show some sign of growth, the world fell into another global financial crisis in 2008. Again, the recovery of the Japanese economy was delayed. And during that period, international investors have turned their attention to sexier market. The term BRIC started appearing in large billion-dollar funds. Most Asia-focused funds avoided Japan and named their funds such as Asia ex-Japan funds. But fast forward a decade, it seems that all these new strategies have not really been working any better. The R in BRIC is no longer even mentioned. The US and China relationship is sort of like a married couple that is now sleeping in different rooms. India and Brazil market have not really been the star performer that everybody thought that they will become. So where can international investor now invest? Maybe preferably in a market that is stable, matured, less risky, and has a good relationship with the US. So that might be the reason now we're seeing a shift in interest towards Japan. But at the same time, Japan was one of the cheapest markets globally. And many of its corporations has huge balance sheet with a lot of cash pile. So much so that more than half of its listed company in the exchange are in net cash position. And it also helped that Warren Buffett basically came out and endorsed the market by buying up huge stake in his top 5 trading houses. So if you feel that this trend will continue, what is the best way for you to gain exposure to the market as well? Well, one ETF that I found is the iShare MSCI Japan ETF. Listed in the US, this ETF has an AUM of around $13 billion, so it's a huge fund. And it trades the MSCI Japan Index passively. This is a combination of around 237 stocks in Japan, mostly across its industrial, consumer, and IT sectors. Some of its top holdings include common names like Toyota, Sony, Mitsubishi, Hitachi, and Sumitomo. The expense ratio, or the cost of holding this ETF, is also quite reasonable at just 0.5% a year. So if you invest $1,000 in this ETF, the fund will basically charge you about $5 from your investment capital as fee every year. And as it is an ETF listed on stock exchange, it means that you can buy and sell at any time for just a simple trading commission. However, investing in any asset classes and market will have its risks. The most notable will be currency risk. The Japanese yen can depreciate against your base currency, and if that happens, of course, you will suffer currency losses. And the companies in the ETF might also underperform going forward, and this will affect the performance of the fund. In the macro environment, the US government is still raising rates to fight inflation, and that could have a direct impact on the global economy. So if high rates bring about a recession across the world, it will most likely affect the Japanese economy as well. So in every opportunity, there will be risk involved. So remember to weigh the two before making any investment decision. My name is Stanley, and this